There's been a growing concern for SCHD investors that everything going on with Trump's tariffs might have a greater impact on the holdings in this fund when compared to the market average. As most of us are likely aware, the CTF just went through its annual reconstitution about 3 weeks ago, where it made some pretty big changes in terms of what sectors they're allocated toward. That includes being more allocated to energy and consumer staples and less allocated to financials and consumer discretionary. Behind a good amount of the concern was an article that was published on Seeking Alpha that was pretty popular last week, which claims that tariffs pose a significant risk to those who love this ETF. It says SCHD is generally a defensive ETF, but not in the context of a trade war. So in this video, we're going to take a look at this article and we'll try and figure out how much danger this fund might be exposed to with these tariffs. It says, the Schwab US Dividend Equity ETF is one of the most popular dividend growth ETFs in the world. Here you can see the rapid growth in its assets under management in recent years. This is true, SCHD has been exploding in popularity and it's now the second largest dividend ETF out there, behind Vanguard's VIG. This growing popularity is the result of this ETF's amazing track record, having managed to pay high and growing dividends year after year, all while keeping up with the total returns offered by the tech-heavy S&P 500 index. This has always been a positive, in my opinion, in regards to SCHD's holdings. Some would disagree, as some people have criticized SCHD for not keeping up with the S&P in terms of share price. But people who make this argument do not understand what SCHD is supposed to do in the first place. SCHD is not supposed to match SPY in terms of share price. It's supposed to still offer share price growth, but its much higher dividend yield and dividend growth make up for that. It has to be all about total return, and you can't just look at share prices with dividend holdings. This ETF doesn't hold much in terms of tech stocks, which have experienced the biggest boom historically, but tech stocks don't pay dividends, so SCHD doesn't focus on those. On the plus side, tech has been more susceptible to being overvalued. So during pullbacks in the market like what we're going through right now, tech has been suffering much harder than the majority of sectors. This is evident by how much more the Nasdaq is down this year compared to the S&P. Going back to the article though, it says, but now, there are growing fears that SCHD could suffer as a result of the major tariffs recently imposed by President Trump. Unlike the S&P 500, which is heavily invested in tech stocks, the SCHD ETF is mostly invested in more traditional, higher-yielding companies that sell physical goods. This is a major disadvantage in the case of a trade war, given that physical goods are much easier to tariff than intangible services. Let's go ahead and compare the holdings of SCHD with the holdings of the S&P 500. The number one sector in the Schwab ETF is consumer defensive at a little over 20%. According to Morningstar, consumer defensive are companies that are engaged in the manufacturing of food, beverages, household and personal products, packaging, or tobacco. The sector also includes companies that provide services, such as educational and training services. So these kind of stocks can include service-based companies not subject to these tariffs, but I'd be willing to bet that a very small number of these are in SCHD. Coming in second are energy companies. As I already pointed out in a recent video, Trump's tariffs largely didn't impact the energy sector. According to this Washington Examiner article, imports of energy products like oil and gas were largely spared from President Donald Trump's sweeping tariffs. Trump, who declared Wednesday, Liberation Day, announced that he would be imposing a baseline 10% tariff on all exports to the US with minimal exceptions and higher tariffs on other nations that impose trade barriers with US goods. Luckily for the energy sector, the White House confirmed in its executive order that energy and energy products were exempt from the reciprocal tariffs. Most energy stocks are still down for other reasons, which include oil prices and a surprise surge in oil production. But this sector shouldn't be hit as hard unless Trump changes things. Then we also have healthcare at 15%, industrials, which will likely take a good hit, and then technology at a little under 10%. So there is some exposure, but not as much as the S&P. Speaking of which, this is what's currently in the S&P 500. You can see that technology does make up a very large percentage of the index. SCHD's largest sector is only 20%, so this index is slightly less diversified. In second place by a wide amount are financials, making up almost 14%. Again, this sector is what experienced the most replacements during SCHD's most recent reconstitution. Then coming in third is healthcare at 11%. Both SPY and SCHD hold an identical amount of consumer cyclical stocks, which are companies whose performance is closely tied to the overall performance of the economy and consumer spending. That would include retail, auto and automotive parts, lodging, and entertainment. The index also holds fewer energy companies. You can see they make up just 3% of the S&P, whereas they make up almost 19% of SCHD. If we compare their top holdings, you'll again notice just how tech-heavy the S&P 500 is. Their top companies are dominated by Apple, Microsoft, Nvidia, Meta, and so on. All of these companies are still going to be negatively impacted by tariffs, but this article is claiming not as much as SCHD. As I'm currently talking about this, there is some confusion about whether Trump's tariffs are going to exclude electronics or not. It was announced over the weekend that computer companies would be exempt, but Trump appears to be saying something different, so at this time it still looks like it's in the air. But let's now look at the Schwab ETF. You can see it does hold a lot of consumer good companies like Coca-Cola and Pepsi, as well as the Home Depot. A lot of these other companies to some degree deal internationally, so there's going to be some pain involved with a lot of these top holdings. So all things considered, does this mean dividend investors should hold off on SCHD and either wait or look for something entirely different? Now, one thing to keep in mind is the yearly reconstitution with this ETF. Every year, Schwab makes adjustments to what's inside of SCHD to align with their investment criteria. That includes holding stocks that have sustained at least 10 consecutive years of dividend payments, have a minimum float-adjusted market capitalization of $500 million USD, and meet minimum liquidity criteria. The index components are then selected by evaluating the highest dividend-yielding stocks based on 4 fundamental base characteristics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks in the index are weighted based on a modified market capitalization approach. If any company held in SCHD no longer meets these requirements, then Schwab will simply get rid of them. That's what makes this fund an appealing long-term holding no matter what's going on in the market. Speaking of which, another point that needs to be made is that it's unlikely that any sector isn't going to be impacted by these tariffs. Even with energy, despite them not experiencing these tariffs, they're still going to be negatively impacted by falling demand, changes in oil production, or just a general rush of investors looking to exit the market. These things will still send stocks down in this sector, and that's what's been going on. Going back to the S&P's holdings, although what they deal with might involve fewer tariffs, if there is a recession that comes from that, then I'd argue SCHD could potentially do better than the index. Tech is still very overvalued right now, and in the event of a huge sell-off, then these stocks would be impacted much greater. That's what's been playing out right now, just assuming this sell-off will continue. Financials and consumer cyclicals are also known to be more severely impacted during downturns. That's 55% of the S&P's holdings. So ultimately, is this article's conclusion correct in that SCHD is at a greater risk? It could be. SCHD will suffer under tariffs and a potential recession, but there isn't going to be a place for investors to wait out tariffs or a potential recession without taking a hit. But it's also just way too early to make a judgment on if we know if it'll be more impacted than the S&P. These tariffs have only been in place for a week. None of SCHD's largest positions have announced any kind of dividend cuts, and with it now yielding over 4%, it's a great buying opportunity to lock in its incredible dividend growth. Its strategy hasn't changed, it's still picking great investments that deliver consistency, and it'll dump any bad companies inside if needed. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.